everyone, and welcome to our webinar on variable annuities. Firstly, about the speaker, Sugata Roy. He's had several years of work experience in various streams of risk management, whether it's asset liability, whether it's hedging of insurance liabilities, market risk management, or economic capital framework, or whether it's market consistency framework. He is a qualified actuary from Society of Actuaries USA and a CFA charter holder. He is also an MBA from IIM Indore. This webinar he'll take today for us is on variable annuities and the risk management challenges in the same, with special reference to the Indian market. In case any one of you has any doubts, you can simply type out the question in the questions panel or mail me your questions to yashu@eneev.com. That's YASHU@eneev.com. So from here, I think Sugata can take over and let's start the webinar.
Sure. Hi everyone, this is Sugata. I'll be your speaker today. First thing first, I need to just read out the disclaimers. These views are expressed by me only, and it doesn't have any relationship to my current employers, and these are only for educational purposes only. It doesn't mean to advise you on any specific investment actions or anything. So with that, we go to the topics directly. First, we will be covering some of the equity-based insurance types. We'll go more detail into variable annuities. Then we will go into how the insurers manage the risks, some of the traditional approaches, and some new developments post the financial collapse of 2008. And then we will also deal into how are the drawbacks of those risk management approaches. And then we will talk a little bit about the equity-based insurance guarantees in Indian market and what's the future over there. So first thing, so when we talk about the insurance equity-linked insurance, there are first thing you have to have one insurance product. The insurance product usually come into two different types. One is the life insurance product, another is the annuities. All the equity-linked, the term equity-linked itself means that you have a market participation with the life product or the annuities product. The simpler of the equity-linked product is probably the variable universal life. Why it is variable? Because your life insurance policy is linked to the market or the equity market. And why it's universal? Because you have a flexibility to pay the premium. So how that works is, let's say you pay some $100 into your life insurance policy. That $100 will be put into one shadow account, and you will be able to allocate that money into equity market or bond market, whatever way you prefer. Now in the next year, let's say you don't want to pay any premium, so you have that option. You cannot pay the premium next year, and the following year you can up the premium. Say instead of $100 you want to pay $300, so you can pay that, and again you will be able to allocate that money into equity product or bond market, whatever way you feel. So you have the option to, or you have the ability to participate in the upside of the equity market. At the same time, the downside is all yours. So you bear the risk of the equity market in there. The next type of product are primarily annuities. So you have two different type of annuities. One is the immediate annuities, and another one is the deferred annuity. Immediate annuity means if you buy one annuity product, you pay the premium, at the same time you start getting the money flow. Whereas the deferred annuities, you have a time to build up your account value. for let's say 5 to 7 years. You pay the premiums, and after that you start getting your money back. Most of the equity-based insurance annuities are type of deferred annuities. So you will have a base annuity product, then you will have a rider. Now for the index annuities, there is no rider as such. You just pay the premium for 5 to 7 years, and that premiums are invested into equity, primarily equity market and the bond market. Now how your account value gets calculated at the end of 7 years, you get some participation from the equity market. So let's say you want to get the upside from S&P index. So you will get the index performance between a floor and a cap. Usually the floor is 3% and a cap of 8%. So whatever S&P performs between that 3 and 8%, you get that money, or your account value gets calculated based on that performance. At the same time, if S&P goes below 3%, you have a minimum crediting rate of that floor. So from your perspective, you kind of buy one call option. Your downside is limited. At the same time, your upside is limited as well with that cap. So that's a type of index annuity. It's popularly known as equity indexed annuities. And the catch here is after 7 years, you have to you really need to annuitize that. You cannot just take a lump sum and get away out of it. The third type of product, which are most complex and most risky of them, are variable annuities product. Now in the variable annuities, you have two types of benefits, two types of riders. One is the living benefit rider, which is basically if the policyholder is living, he gets those benefits, and another one is the death benefit. So in case the policyholder dies, he gets that benefit. So for variable annuities, there again will be a base annuity contract, and then there will be the riders. Those living benefits and the death benefits are the riders, for which you have to pay extra premium. Now the death benefit basically guarantees the amount of the policyholder is going to get, or policyholder's nominee is going to get in case of his death. It's a guaranteed amount. So what that means is if the market, your money is invested into some equity and bond fund, if the market goes above the guarantees, then you will get the full upside. The same time, if it goes below, you will definitely get that guaranteed amount. Similarly, there are three other popular type of living benefits. GMAB is a guaranteed minimum accumulation benefit. GMIB is the guaranteed minimum income benefit, and WB is the withdrawal benefit. We'll see about those living benefits in more detail in the next slide. So the first chart here, the example of GMAB, if you see that green line over there is that initial premium amount, and the blue line over there is the how the market value of that or how the fund value moves in different years. Now as long as it's up, that initial purchase amount or some multiple of it, let's say you pay $100 and the insurance company has promised you a minimum guarantee of, let's say, 120. So as long as your fund value is above 120, you will get the full fund value. But if it goes below 120, then you will get the minimum of 120. So the insurance company is on the hook for that additional amount. The next example, GMIB, it again it says that you will get a minimum crediting rate of let's say 5%, and as well as you will have a highest anniversary value, and then at the end of your policy term, you have to have you need to annuitize this policy. So what happens is, at the end of the policy term, the insurance company will calculate for next 20 years what is going to be your highest income stream, and that's how your money or account value will get calculated at the end of your policy term. So highest of these three, if you see there, the orange line is the 5% compound annual growth, and the blue line, which is the highest anniversary value, the highest of these three will be your account value at the end of your policy term, and after that you have to annuitize that to get the benefit. The next example is the withdrawal benefit. So for the withdrawal benefit, you don't need to annuitize. So for 5 to 7 years you pay the premium, and your account value gets calculated by either market or some kind of step up guarantee. So again, what that means is you get the full upside, and your downside is limited to that guarantee level. Now when the policy ends, you don't need to annuitize it. What you can say, there is like a minimum withdrawal amount. So you can withdraw 5% or 7% of the account value every year until your account value gets exhausted. Your initial account value gets exhausted. So first year you withdraw 7%, second year you withdraw 7%, you continue to do that. Let's say after 10 years your actual account value goes to 0, but you still be able to withdraw your entire 100% what was at the end of your policy term. So in this example, that green line, it gets exhausted at the end of 15 years, but you will still be able to get all your 100% money, whatever it was at the start of annuitization or the end of the policy term, and you can continue get that minimum 5% for next 20 years. So what that means from an insurance company's perspective, they do not really have any risk as long as it's a bull market. So when there is the fund value is higher than the guarantee amount, the insurance companies are good. It's all your money. It's coming from your fund value. But the risk comes when this fund value goes below, or the equity market goes below the initial guarantee amount. So from insurance companies' perspective, these variable annuity riders are like writing a put option. So as long as it's above a certain, the market is above the certain guarantee amount, they just collect the premium. So that's like collecting the premium as long as it's over the strike. But their liability comes into picture when the equity market tanks. There is a huge market for this kind of variable annuity riders. Usually people buy those like 5 to 10 years before their retirement, so that at the end of their retirement they can either annuitize it, or in case of withdrawal benefit they can withdraw like certain percentage every year for next 10-20 years. And also in some cases, not all, in some cases there are tax benefits as well in US market. So what happened was during 98 to 2008 time frame, when the market in US was relatively good, there was a huge rally in variable annuities market. So every year it went up by the annual growth of the variable annuities were around 9 to 10% annualized. And during like 2005 to 2008 time frame, when the equity market was booming, all the insurance companies were very aggressive about offering the living benefit guarantees, and they also allowed you to even invest like 90% of your money in equity market. So that became very competitive market, and as well as the baby boomers were approaching the retirement. So this market really exploded. At one point, like at the peak, they had the entire industry of variable annuities had some $1,800 billion in total asset under management. Now, after that 2008 happened. So as we spoke in our previous slide, you saw that each of these riders are essentially a put option. Now, the put option has three main handles with which the value of the put option gets determined. One is the strike or value of the underlying. Number two is the interest rate, and the third is the volatility. Now, if you remember 2008, the interest rates were very low. The volatility went up to somewhere around 80%, as well as the equity market tanked. So those insurance companies got really hit by this variable annuities product, because the rider value, the base annuity product did not get impact, but the rider values swelled so much that some of those companies were even got like they had to get government money to manage their liquidity positions. It was that bad. So if you really think about how the variable annuities work, you have a base contract and then the rider, with which the strike is, that rider is itself is a put option with a strike which is the guarantee amount. The underlying is the fund value, which again depends upon like how you invest your money. Say you want to make an investment allocation of 80-20 versus like 60-40. It depends upon how you invest your fund. And then there is also the maturity is not fixed. It depends upon till what time the policyholder wants to hold that rider. And in case of death benefits, it is contingent upon like the death of the policyholder. So it is essentially a base annuity product as well as a very complex capital market security. In normal capital market derivatives, you see they have different exotic options, but this one is probably the worst of them. I mean, it's very complex. There is no really closed-end solutions for this one. You have to get the liability value for those variable annuities. You have to really run a stochastic scenarios to get the liability values of those. How the insurance companies respond to that crisis? They had basically 3 or 4 levers to pull. One was managing the risk of the mortality and lapse. Basically, this mortality or lapse that determines the maturity of the variable annuity, that rider part of the variable annuity contract, which was written by the insurer. Now, this mortality is more or less a stable thing. If you the actuaries have generated like good number of mortality tables. So the mortality itself was not that bad, and usually if you write a large number of policies, then your mortality experience is very close to what you have in the actuarial tables. So that was well managed for the death benefit, but the biggest part was the lapse. Now, lapse is something which is controlled by the policyholder. Usually what happens is lapse kind of slow down. So when you price any insurance policies, there is a lapse assumption into that, goes into that pricing. Now, those for variable annuities, usually the lapses slow down when the benefits are in the money. That means when the stock market is in the decline, those guarantee amount is favorable for the policyholders, and of course the policyholder do not want to lapse on those for which they are in the money. And again, they usually speed up, the lapse speed up when the benefits are out of the money. So for the rider, when the policyholder sees his account value is way up than the guarantee amount, he doesn't want to pay extra premium for the variable, the guarantees, right? So let's say I am retiring in next year and I see my account value is 1,000 and my guarantee amount is like 300. Why do I want to pay extra for the guarantee? So I just lapse. So the risk is not that the policyholder is lapsing or not lapsing, because that assumption is already baked into the pricing. The risk comes from when the actual experience doesn't match with your assumption. So in 2008, what was happening was the policyholders were lapsing even slower than what was assumed. So insurance companies had like a formula that if this is in the money for 80%, some 5% of the people will lapse, but that did not happen. So even from that perspective, they were having higher risk coming from the lapses or the policyholder behaviors. So after that, they kind of learned their lessons, and they basically revamped their how those lapse formulas work. So post 2008, a lot of insurance companies have included different kind of factors like age, gender, economic background, whether someone is getting advised by a sub-advisors, things like that in their dynamic lapse assumption. And a lot of insurance are using a predictive modeling, some rudimentary kind of predictive modeling for the policyholder behaviors, and that's how they matched the actual lapse assumption better than what was happened. So that 2008 phenomenon was a big game changer even for this mortality and lapse, which is in the field of life insurance for long time. They had to change that too. The other one was how to manage the actual market risk of those guarantees, which was coming from the strikes and the volatility of the written put options embedded into those variable annuities. Some of the insurers in 2005 to 2008 who started writing those policies in that time frame, they only saw the good times. So they decided not to hedge those guarantees, and all of them are out of VA business now. Companies like Manulife, even my current employer, they are all out of, they do not write the VA anymore. All of them have some legacy legacy business which was written at that time frame, and it's still in there. So they still need to manage the risk for them, but they stopped writing the new businesses. Then there was reinsurance. So some of the insurer, what they did, they wrote those policies and they went to the reinsurance firms and got reinsurance for those policies. But there was a decline in stock market in around 2003, and in 2003 those reinsurers got hit by those variable annuities product. So they stopped writing any more reinsurance for variable annuities. So what the insurance companies started doing was they pretty much started self-insuring for those, like doing dynamic hedging kind of framework on their own. So what dynamic hedging means is you basically replicate the payoff of those embedded put options in variable annuities by available derivatives. So if you see this embedded derivative is a written put option, so it has mainly three sensitivities, which is the sensitivity to the market, which is delta, then sensitivity to the volatility, vega, and sensitivity to the rates, which is rho. If you can match, if you can have a like a set of assets which has the same kind of sensitivity to the market, volatility, and rates, you are pretty much hedged against your liability movement, right? That's what insurance companies started doing around like after 2003 to 3 time frame. Like almost all the insurance companies who decided to hedge the variable annuities, they had some kind of dynamic hedging program. I mean, some had very simple dynamic hedging program. They will just hedge the one of the Greeks, let's say delta. Some of them had a 3 Greek strategy. Some of them decided we will hedge full delta and full rho, but some percentage of vega. But they all had some kind of dynamic hedging program. So let's talk a little bit about how those dynamic hedging program works. The picture, the chart above here is like a very simple version of a dynamic hedging framework. So on the right hand side you have a liability model. The actuarial assumptions such as mortality, the dynamic lapse formula get fit into the liability model. And as I said earlier, those liabilities or the variable annuities riders, they are very, very complex. They usually do not have any closed-end solutions. So you really need to run a bunch of stochastic scenarios to calculate the liability. So what happens is I captured the market condition as of end of today. I feed those market data to the stochastic scenario generator, then it runs, usually these are risk neutral stochastic scenarios. So those stochastic scenario generator then run like 1,000 paths based on my current market condition, and the liability model then runs the liabilities and calculates the cash flow discounted back for each of these 1,000 paths, and then we take an average of those thousands to call it a end of day liability. And how you calculate the Greeks, you shock the market condition, let's say the index by 1% and down 1%, and then again you run those 1,000 scenarios and you then calculate the liability. And that's how you calculate the sensitivity to the market, to the index. Then similarly you do the same thing for the volatility and same thing for the interest rates. On the asset side, it's relatively simpler because most of the assets which are used for hedging or the insurance companies usually use for hedging are closed-ended ones. So you really do not need to run those asset models in with the stochastic scenarios unless you are doing some kind of like a value at risk kind of project. But I mean, just for like the Greek calculation and for dynamic hedging, you don't need any stochastic scenarios for the assets. So you just feed the market data, you use like the simple Black-Scholes or whatever to calculate the asset values, and also the Greeks. And at the before the start of the market, the next day, you compare the liability Greeks with the asset Greeks. And if you see there is a difference between coming from the asset Greeks and the liability Greeks, you feed that report to the trading floor, who then either purchases or sells some of the assets, and that's how they rebalance the Greeks to match the or the replicate the liability with the assets. Usually the insurance companies use like the equity futures or equity related total return swaps or like plain vanilla put options to get the delta. For rho they usually use IR futures, IR swaps. For vega they usually the vega source of vega is mainly vanilla options and variance swaps. And sometimes they also purchase some kind of exotic instruments, but that's not very common in dynamic hedging program. But the dynamic hedging program doesn't really address everything. It, as we saw earlier, it only mitigates some of the risk. It doesn't mitigate all of the risk. For example, your uh, your dynamic hedging program is usually geared towards delta, vega, rho, and some of the insurance companies, they do not actually hedge 100% of vega because like buying the put options or buying the variance swaps are very, very costly. These are not exchange traded derivatives, so you have to go for the over-the-counter derivatives, and those get costly. So sometimes they decide not to hedge full vega. And then there is also higher order Greeks which you are completely ignoring. Now on a normal day-to-day market, these are fine. Like the delta vega rho will explain about 80%, 80 to 85% of how the liability moves. But on days like during the financial crisis, those higher order Greeks become very, very significant because you are seeing a very big changes, day-to-day changes in stock market. So the volatility impact on the index or the index impact on the rates become very, very high. And if you ignore those, you are ignoring like a big portion of how the liability changes. So the liability goes up significantly, but the dynamic hedging asset portfolio doesn't go up that much, and you get a very big breakage from the dynamic hedging program. Then there is like a pricing impact. What that means is usually when the actuaries price those variable annuities, they look at the historical market condition, and they tend to price competitively so that using those historical market conditions, so that like their policies get sold, right? I mean, if you make it very, very costly, nobody is going to buy it. So what happens is during those financial crises, those assumptions, those historical market assumptions are no longer reflecting the current market conditions, and you have to buy lot of vega or lot of delta which you have not baked into your pricing, so you get like a big pricing impact too. The third one is the basis risk. So what happens is when I invest my money in variable annuities, I can allocate my money into different funds. Now when you try to hedge those variable annuities, you are actually buying some kind of equity index linked derivatives. So my fund, whatever I have invested on, may not be reflecting that index as such. So you get a breakage from those fund movement and the index movement. So let's say I invested some 80% of my money into some S&P linked fund, but they are not really, there will be some basis difference between the fund value itself with the with the index performance, because the fund manager, he doesn't rebalance his fund every day. He might try to get some more alpha and like pursuing that alpha can give you like some negative performance as well. So there is a difference basis risk between how the actual market value of my policy gets calculated and how the hedge indices perform. Also, when you try to buy the insurance, buy the over-the-counter derivatives, during the financial crisis, nobody was willing to sell those derivatives. So none of the investment banks were willing to sell those, and that's when there was a really liquidity in the market. So even if the insurer were trying to hedge those, they could not find the right instrument unless they pay very, very high price for those over-the-counter market. So the bid-ask spreads widens during those stress market. Also, as we saw, there is a counterparty risk as well. So when you are buying some kind of derivative instruments, you are basically relying on the counterparty to oblige on those contracts. Now, some of those big banks, those failed during those financial crises, so there is a very big credit risk those program as well. Of course, there is a risk of systemic failure, like all the insurer, all the banks, the total market collapses. uh, Even we saw that too, right? And the most, I think one of the most critical thing is like controlling and execution. Usually the insurance companies were very good into managing mortality and lapse and basically writing basic annuities and life type of product. Now, when they started doing this dynamic hedging, they started having a like mini investment bank kind of trading floor in their premises, and historically not many of their controls and execution policies were geared towards that kind of environment. So there was a huge operational risk in that. Now, right now the things have changed quite a bit. Since they have the experience of 2008, they have started having like lot of controls and executions, and they have started some kind of some good skills from which is very similar to the big investment banks, and they most of them have a pretty good derivative systems and a derivative trading floor. But still there is a good bit of operational risk in there. And as we saw during the financial crisis of 2008, whatever could go wrong, everything went wrong. And some of the big insurance companies, they had to actually went to the government to get some TARP money. They could not manage their liquidity positions there. And at one point, I remember one of my previous employer place, the liability increased by $1 billion in one day. And usually, like on a normal day-to-day, 90% of the days we usually saw a liability change of maybe like 20 to 30 million. But imagine it went up by $1 billion in one day. And then there is accounting perspective as well. So in dynamic hedging, what you are trying to do is basically match the assets match the liability Greek profile with the asset Greek profile. But in accounting, assets and liabilities do not get valued in the same way. For example, for the GAAP, the assets are all get mark to market every day. But for liabilities, it's essentially a host and a host contract and a guarantee contract, right? So that valuing that host contract is not very difficult. You have actuarial models for that. But for the guarantee part, what GAAP suggests is you need to have a market. If you have a similar market, then that fair market value is your value for those guarantees, or otherwise you have to mark to model. Now, for most of these exotic guarantees, there is no really fair market value available in the market. So all of them are mark to model. Now, when you try to do a mark to model for in the liability and you are doing a mark to market with the assets, there gets a breakage in the earning. You can actually manage the program to maximize the GAAP earnings, but then you are losing the true economics of those liabilities. So there comes a slippage in there. The other one is the regulatory aspect. So if you try to go for a regulatory, maximize the regulatory or minimize the regulatory reserve or maximize the regulatory capital, you can do that too. In such cases, there are programs to calculate the reserves. For example, we use VA Carvum in US for those VA liabilities, and we use a C3 phase 2A, like a CTE kind of framework for capital. And on the asset side, what STAT says is you can have whatever in your book as of today, those get valued. So you do not really get any credit for the dynamic hedging. Now again, you can manage the program such way that your reserves are minimized, your capital are maximized, and you get like higher stat earnings, but it doesn't follow the true economics of those VA liability blocks. The third thing you can do is target actually the economics of those blocks. If you do that, you are really risk matched, and you are really market risk of those liabilities get significantly away. But when you report your GAAP earnings every quarter, you get significant breakage from those programs, from those since there is like a difference in asset valuation and the liability valuation, your liability doesn't go down as much as the assets go. So you see a higher impact on the actual GAAP earnings. So you can actually pick any one of them and try to maximize it using the hedging program. Most of the companies prior to 2008, they were mostly trying to enhance their GAAP earnings, and their hedging program were mostly GAAP-based hedging program. But post 2008, we are seeing more and more companies are trying to target the true economics, and they said, yeah, whatever, we will take the hit on the GAAP earnings, but we will really manage the market risk on its true sense. Post 2008, we also saw some very knee-jerk reactions in variable annuities market. Some of the companies went away. They stopped writing new VA products. Some of them increased the price of the guarantees. When you think about it, it's basically they are charging higher premium for writing the same option, and they are basically trying to hedge the risk of lower pricing. Some of them reduce the benefits. Your guarantee amount got reduced. You do not have those generous guarantee ratcheting up or like increasing every year by a certain percentage. So what that means is you are basically trying to lower the strike of the put option. And then there is a third type of reaction. What they are trying to restrict the fund allocation, which previously you could do, let's say 20% in the bond market and 80% in the equity market. They have lowered that to 60-40 or even 50-50 and things like that. So basically they are trying to lower the notional on those put option so that their total risk position is lower. Now some of the recent developments in managing the variable annuity risk. So the insurance companies realized that when you take that liability into book, you cannot, I mean, if you try to hedge those dynamically and you are trying to target the true economics of those, you get a significant breakage in your reported earnings. So instead, what the recent developments, what they're trying to do is, instead of manage the risk at the policy level, they are managing the risk at the fund level. So the funds the insurance companies are providing as investment allocation options, they are like managed or risk managed on their own. So for example, there is a new fund in the market called Volatility Managed Fund. What they do is they dynamically allocate the fund in between inside of the fund based on the volatility of the index, and with that they target a fixed volatility. So let's say you target the volatility to be fund to be 15% all the time. So what you are doing is, if the equity market or the S&P or whatever index you are following has a volatility less than 50%, then 100% of your money is allocated into S&P fund. But if it is higher than 15%, then that some of that money goes to bond market or cash market or whatever with a lower volatility, so that total volatility of that fund is still 15%. So for example, if the S&P index, the volatility goes to 30%, then 50% of the money will go to a cash money market kind of fund, and the rest 50% will remain in S&P. So instead of having a fixed 20/80 or 60/40 kind of allocation, you are dynamically managing the allocation inside that fund. So when you are trying to price the policy, you know this fund will always have a 15% volatility, and with that certainty I can easily price the policy. Some of the funds actually they overlay derivatives inside the fund, so that they have a very consistent vega and very consistent row profile, and they manage those risks inside the fund instead of managing the risk at the policyholder level. Another recent development was indexing the premium on volatility. So if you have your fund has a volatility of, let's say, 5%, you will be charged X% as premium. If it is 15%, you will be charged 3X as premium. So they basically are trying to charge you based on how the volatility of the fund behaves, so that they are not undercharging you for the hedging instruments. Those volatility managed funds have become a very big hit in the market, and it's pretty big as of today. It's getting bigger every day, and so for insurance companies' perspective, it's very convenient for them to have a fixed volatility on their fund, and it reduces the vega exposure significantly. And if you think about it, what they are trying to do is, when there is a higher volatility, they are moving some money into bond market or cash market or whatever it is. And when you see higher volatility, when the stock market tanks, right? So you are essentially moving money away from the equity market to bond market when the stock market is tanking, and you are taking that money back to equity market when the volatility reduces, that is, the stock market goes up. So generally there is a higher alpha in those kind of funds, even if it is truly linked to S&P. But if you just follow this kind of target volatility, generally there is a higher alpha. It's not true all the time, but generally it will have a higher alpha around 80% of the time. The other thing is that it reduces the vega exposure significantly, but it doesn't impact the delta or the row profile. So you still need a dynamic hedging program, but that dynamic hedging program is very, very simplistic, and it's less costly, because the main cost for the dynamic hedging program comes when you try to buy the vega. Those vega instruments are very, very costly. You have to buy either a put option or a variance swap, and that's why some of the insurance companies decided not to hedge vega in the first place. So with that volatility managed fund, that big cost has gone, and it has much, much more consistent vega. And that is why it's steadily gaining popularity. I mean, there are a lot of fund managers nowadays. They're offering this kind of volatility managed fund. All right. So with that, we'll briefly touch upon the equity-linked insurance market in India. If you remember, there was a big rally in insurance asset under management due to ULIP, unit-linked policies. those were equity-linked policies, definitely, but I won't say these were really insurance product as such. There was very little insurance component into it. It was mostly like a mutual fund, uh, like dressed up as a insurance product. So what the regulators, IRDA, decided to do in 2010, they realized that there is a lot of mis-selling going on. These are not really helping the policyholders' cause. So they brought into one regulation with which the first generation of unit-linked policies has basically disappeared from the market. Now there was another wave of a highest NAV, net asset value guaranteed ULIP product, which were pretty big, which were the largest selling unit linked since 2010. What they used to follow is basically use the CPPI strategy, constant proportion portfolio insurance. What that means is they allocate the money between the bond and the equity market so that your minimum guarantee is always preserved. So let's say your guarantee is $100 and you pay a premium of let's say $90. Now the part of the money, let's say 80, will be invested in bond market so that you get that at least that guaranteed amount 5 years from now, and the rest 10% or rest $10 will be invested into the equity market. Now as the equity market performs better, so that 10 becomes 20, 30, then you have like higher percentage of your money getting invested into the equity market. But if it starts tanking, then like all of your equity market money will go into this bond because you need to preserve that guarantee amount. So it is, if you think about it, it's not really aligned to the stock market. It doesn't give you the actual stock market performance, and it can get cash locked, especially during like the later part of your policy or the index tanks. It can get like totally, the total amount of money will be invested into some kind of bonds, and you can get cash locked there. You don't have any participation in market. So post, I think starting 1st October this year, IRDA has stopped selling. I mean, they asked the insurer to stop sell those products as well. So pretty much there are not a lot of equity-linked products in India currently, but there is obviously a market for these products. If you think about it, why the VA products were successful in the first place in US, a lot of baby boomers were approaching their retirements, and these products are essentially a retirement planning products. Now the similar way, some of the Gen X, which were like the affluent middle class, the first wave of affluent middle class in India, they will approach their retirement in next 5 to 10 years. So this is a very high time when if they have a if the insurance companies can get into those VA type of or equity linked type of product, there will be of course those. With that, with those kind of products, what you can do is like when you are approaching your retirement for last 7 to 10 years, you can pay the premiums and can lock in some of the upside in the market as a guarantee. And nowadays, I mean, it's almost like every 5 years or every 3 years you see a boom and bust. Unfortunately, even if during your retirement or like that retirement time frame there is a bust in the stock market, you will be still preserving your upside in the market for that will come in whatever comes in next 7 to 10 years. So there is of course a market in India, but there are a lot of regulatory hurdles in that. First of all, the insurance companies over there, they do not have approvals for like all the derivative usage, what the US companies can do here. There are some draft regulations going on, but to best of my knowledge, again, I am not an expert in the equity-linked insurance market in India, but to best of my knowledge, the derivative users are very much geared towards managing the risk of the asset books. So, for example, you can trade some swaps or interest rate futures to maintain your, or the credit default swaps to maintain the credit profile of your asset book, or to maintain the interest rate profile of your asset book, but it's not geared towards like hedging, the truly hedging the liabilities. And also the other problem is that the insurance, the derivative market over there is not very deep. It's not very liquid. Lot of instruments are not even introduced there. However, I think I mean it's high time to introduce those, and if the regulators are approving some of those derivative usage, it can help both the ways. It will make the derivative market much more liquid over there. At the same time, it will help the policyholders' cause. However, I mean, I'm sure there are some very bright minds are working over there. They will know the right time to introduce those things. The other thing with the framework, what we can do is probably have a managed volatility funds, and with that, the big risk of managing the vega goes away, and you can still you will still be responsible for the delta and rho. Now, with the regulatory approval of hedging the delta and rho, like if you can invest in some kind of equity futures and interest futures or interest rate swaps, then you can manage the delta and rho profile very well. So there is a way to introduce some of the variable annuities product, the guaranteed product. And I think like some of the fund management house can truly look into this managed volatility funds. This can be a good option. So with that, we come to the end of our presentation today. Some of the key points, I know it's a lot to digest, but some of the key points I will like you to take away with you. These are, of course, the variable annuities guarantees are very complex, and they are like exotic derivative contracts. And I mean, if you do not have a way to reinsure those, you need to have like a self-insurance kind of a program with dynamic hedging. Some of the issues with the dynamic hedging, of course, you have the accounting issues during the stress market. When you need the dynamic hedging the most, it doesn't function very good. You get like a basis risk, liquidity risk, counterparty risk, and then there are some unaccounted risk as well, like higher order Greeks. Then we also touched upon some of the recent developments in US market, which are the volatility, managed volatility funds. Some of the insurance companies are trying to index the premium with the volatility, which they did not do before. As far the Indian market is concerned, right now there are not a lot of equity-linked products over there, primarily due to regulatory guidelines of using the derivatives. With current framework, there are not a lot of options. However, if there is a good potential in that market, so to like really introduce those products, we need further development in the derivative markets, and I think the managed volatility can be a good option. So with that, we'll take the questions if you have any.
I think that brings us to the end of the webinar, and I think it was a very detailed and very well explained webinar, but we are kind of running out of time and there have been no questions so far. I'm guessing that was because it was so well explained. So I think in case anybody has any doubts, they can probably mail it to us because we're running out of time. So you can simply mail it to info@edupristine.com. That's info@edupristine.com. Thank you everyone for attending.
Thank you.